Okay, great. Welcome, everyone. Thanks for joining us. We're going to jump in here and we're going to talk to Tim Travis. This is another episode of Dynamic Investing. Tim Travis is with TNT Capital Management, and I've known Tim for maybe 20 years now or so, and he runs a great firm, he and his brother Pete. And maybe, Tim, you'd like to tell us a little bit about what you do, but before we get started, I want to read something here and just make a note that there is always risk in all investing, and options trading is not suitable for investors, for all investors. And please consult your investment advisor before taking any action. And past performance is never a guarantee or never indicative of future results, I should say. So, with that said, Tim, maybe you can take just a minute to introduce yourself. Tell us exactly what you do, what's your edge, what's your niche, and then we
Yeah,
can dig deep into some tickers.
yeah, absolutely. So we started TNT Capital Management at the in 2011, actually, and it's been tremendous blessing. I can't believe it's been 15 years already. It's just
Wow.
crazy to think about. But the concept was I had worked in the financial services industry for a long time, and I saw a model that I didn't really like. It was just kind of an asset gathering model. It wasn't really focused on the actual investing strategies. And I was a lifelong Warren Buffett fan. And once I learned about value investing and the Benjamin Graham concepts of margin of safety and intrinsic value, it really captivated me. And I once I learned how to kind of value businesses and how they invest, I was shocked that more people don't try to emulate that kind of style. And so that I thought, hey, look, there's a niche here. If we can provide these types of strategies, to the retail investors, uh, they're going to want that. That's what I invest my own money in. And then actually working with you, Eric, I mean, that was goodness gracious, that was 2007, I believe. Yeah,
Right.
2000. I actually no. I started working for you in 2005, believe it or not.
Wow.
So
Okay.
2005, yeah. And we were doing a lot of selling of options on the indices, as you well know. And it
Right.
was really interesting to me because the vast majority of those trades were successful. So it was there that I really learned that there's statistical advantages towards selling options and not being, the buyer of options. But the change that I made, that we weren't doing at that firm, was incorporating it, tying the options in with the value investing. So as you know, we would do like covered calls. I mean, we would do iron condors and stuff like that on the index,
Right.
and maybe 80% would work. But then when they went bad, you kind of just took a permanent loss of capital. So what we want to do is we want to sell puts on stocks we want to own anyways. And so either heads, if the option expires worthless, we make 100% of our profit and it's all good. And if B tails, we get exercised on the stock and we sell a put and it gets exercised below the strike price, then we end up owning that stock and we've got all the upside or downside there. So it's been a great strategy for us and worked out well. So very grateful. So grateful to you for kind of introducing me to options back then, a long time ago.
Oh, yeah. There's certainly a lot to talk about there, but
Yeah.
that's for another time.
Yes,
Absolutely.
sir.
But, options are just a tool. You can apply them to really just about any asset these days. And, what you're doing, I think, is spectacular with the approach you have and sort of creating and defining a real value add, I should say, and an edge. I think a lot of money managers are, like you suggested, asset gathering, and they look at it more as a lifestyle approach
Right,
rather than um, trying to actually outperform the market.
right,
So, that's not always an easy thing to do, but I think that's just because there's so much passive investing now and so much allocated to index funds. And, ultimately, if you're going to look to outperform, you're going to have to do your homework and
right.
and do some research on that. So that's great. So, you talk about value investing, Benjamin Graham and Warren Buffett and some of the bigger names. But then you also, I know in the past you've talked about deep value. So is there a definition there between the two, or a distinction between
They're
the two?
similarly linked. They're similarly linked. I think deep value kind of connotates more to a contrarian investment style. Often the best opportunities are ones that have the most hair on them, where
Hmm.
I mean, a lot of times it's stocks that are in the headlines where, clients will say like, "Why do we own this? I just read in the Wall Street Journal, blah blah blah, this negative storyline." And it's like, well, that's exactly why, because a lot of people aren't going to do that extra due diligence and okay, what is this worth? Obviously, there's some type of, headwind impacting the business to why these articles are being written about it or why the stock's kind of sold off a little bit. But that's where you get the opportunities to buy quality businesses at large discounts. For instance, when American Express had their salad oil scandal, I want to say that was in the 70s, I believe. But basically, it was an issue where a company that was a creditor of American Express, they lied about their inventory, and what was supposed to be something ended up just being like salad oil, or I forget, or no, it was water. It was supposed to be salad dressing, and it ended up just being buckets full of water.
Water or soybean
Yeah,
oil or something. Okay.
yeah, and so that caused American Express stock to go down a lot, and that's when Buffett started buying, and it's been one of his best investments. Same with Coke. When they made the change to new Coke, the new formula, the stock tanked, and Buffett bought it, and it's just been a huge winner. So often the best winners are kind of the ones that have a lot of hair on it, but they're actually good underlying businesses.
Yeah, absolutely makes sense. So much of what people do is based on clickbait headlines, narratives, uh, too much time watching, business channels and looking for the hot tip. I mean, there's nothing
Right.
wrong with being informed, of course, but I'm not sure any of that is really actionable, or
No.
um, it makes sense to act on it. I mean, if millions of others are, I guess there's really no edge in that, is the bottom line. So
There's not, Eric. And
yeah,
and you know where there is an edge is ignoring that and
right,
being patient. Like that's the hardest thing. And often I'll talk to clients and I'll be like, "Look, I don't look at my account value daily. I don't even look at it weekly personally, my personal account value.
right,
I don't really look up my monthly statements. I'll look a couple of times a year, but I mean I know what's going on in it.
right.
It's just that mark to market noise is just that it's noise. You want to focus on your process and making business like decisions. And you made a really good comment earlier. Right now, it's very hard to bet against passive investing because we've been on such a crazy run since 2009. After, from 2000 to 2009, we had two 50% sell-offs, massive. The Nasdaq went down 80% 2000
80%,
to,
right,
yeah, 2000 to 2003. And as you well know, the market did nothing for 13 years. And even the best companies like Microsoft and Cisco, and Intel back then, they were negative during that whole time frame. And as you know, having been in the business as long as you've been in, people wanted gold coins. They wanted annuities. Remember everyone was saying that buy and hold is dead. That was the narrative. And so, but now it's the opposite. Now it's, oh, you just buy the index and you don't worry about it. But the problem is that valuations are the highest they've ever been since 2000. And so and a lot of these margins look really inflated. What's going to happen with AI? Is that sustainable? So I think that there's going to be a time where these option strategies are enormously helpful in protecting and reducing risk. But I know there's a few specific areas that you wanted to touch on.
yeah, absolutely. So why don't we jump into that? And absolutely, like you said, there was such a crazy environment. You had, the ZIRP policy, zero interest rate
Right.
policy, and that just helped, you know, fan the flames after the 2008, 2009 era. And so that environment is over with, different
Yeah.
landscape, but you have all these flows constantly moving into the passive funds. But, ultimately, you get this concentration of risk. I mean, you have, what is it, the Mag 7, I think, was something like 35%.
35%, something
Is
like
that
that.
right?
Yeah,
Yeah.
it's massive.
So that's certainly not sustainable.
No.
But in any case, so let's go ahead and I know there's some tickers and so forth. And
Yeah,
speaking of headlines, so certainly in the last several days, the last week or so, I guess you could say these BDCs or business development companies, uh, maybe you could explain exactly what they are. Private credit,
private
probably hearing a
credit,
lot about.
exactly.
Yeah.
Yeah,
So,
there's a lot of hysteria in that arena, Eric. And so basically, private credit are basically loans to companies. A lot of these companies are mid-market, maybe 50, 150 million dollars in EBITDA, just depending on some of these are bigger, some of these are smaller. And they're generally first lien loans. There's relatively strict credit protections associated with those loans. And a lot of these are kind of private equity buyouts.
okay.
And so right now there's a lot of fear out there because one, where are we in the economic cycle? So you might think that maybe we're heading towards a recession, maybe this war, if inflation picks up or oil prices stay so high, maybe that puts us in a recession. And then also it's okay, what's the impact on AI? A good percentage of these private credit loans are software, just like a good percentage of the S&P 500 software.
Hmm.
And so the fear is, well, what if AI displaces a lot of these companies? And you've seen like Microsoft's down 20-25%, Adobe's down
Right.
40%, Salesforce.com, same thing. I mean, a lot of these stocks have just gotten crushed. And so but here's what's interesting. So business development companies are basically a essentially like a fund. They own a bunch of different loans. They finance, those are the assets. The assets are loans. Generally 90% are first lien loans.
Hmm.
And then they're financed by debt. And so then there's equity. So they have net asset values associated with them. And so these companies, due to the tax code for them, they pay out the vast majority of their taxable income as dividends. So they tend to have very high
Okay.
dividend yields. And so this fear that's going out there has caused a lot of these business development companies to now trade at fractions of their liquidation value, their net asset value. So, really high quality companies such as Blue Owl Development Company or Morgan Stanley Direct Lending,
Okay.
uh, Blue Owl Technology Fund. There's a bunch of them. Kane Anderson. There's Blackstone security lending. There's a bunch of these, and they're trading at 24 to 35% discounts to their net asset values, and they have dividend yields of 13%. And
Wow.
whenever you get fear, you get kind of the market pundits going on CNBC and saying, "Oh, I think private credit might be the next, 2008 or whatever." And we saw it a couple years ago when higher interest rates were causing depositors to leave some of the banks and invest in higher yielding stuff. And so you had bank runs at like SBC Capital and some of those other banks, and then you had pundits saying, "Oh, well, Bank of America is going to go bankrupt," and all that stuff. So you have this hysteria. But here's the thing: what I like about private debt is that these are separate loans. Like the top 10 loans on a lot of these companies might be 13% of the portfolio. So,
Okay.
and these are all different companies, right? So, a few of them are going to run into problems. I mean, whenever you lend to hundreds of companies, you're going to have credit losses. That's inevitable. But I don't see it being systemic by any stretch of the imagination. They're very diversified. They're generally defensive industries. They're not super cyclical, not super reliant on like the housing market per se or anything like that. And at these prices, Eric, you have a huge margin of safety.
Okay.
So credit losses would have to increase 5, 10, 15 times to really create damage from these prices for a long-term shareholder. And one of the
Okay.
things I also like is to go on a bit is so I we've invested a lot in the banks over the years. And a lot of the times we were buying those banks at large discounts to tangible book value or liquidation value. And the 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 fear always outweighed the reality of the situation. And what stunk was like during COVID or even during that credit crisis a few years ago, or the interest rate uh, uh, hysteria that occurred a couple years ago. The banks have to start limiting their dividend growth, their buybacks, because it's so heavily regulated. But what's
Hmm.
cool about these companies is you're getting almost all of their income as dividends. So you get these huge yields, and those dividends, they might get cut a little bit because rates are going down and these are adjustable rate loans, but you have a big margin of safety there. And so even if the market tanks, these are much more like debt instruments than just pure equity. But I think you can get equity like returns because if the stocks are flat from here, you get that 13% dividend yield.
Right.
If they converge, like if they even get close to net asset value, we're talking 30% returns. And I think that they will get there. So we're
Okay.
optimistic, bottom line.
So is it fair to say that these institutions, and I guess I think I know the answer, but you tell me, but the reason people go to them is because it's outside of the banking system, outside of the banking regulations,
Uh,
is
to some extent, the regulatory environment changed so much that it made it really prohibitive for the banks to keep certain types of loans on the balance sheet.
right. Okay.
And so yeah, and then these sponsors like Blackstone's doing so much business, Blue Owl's doing so much business, KKR, so they develop vehicles to buy some of this debt and finance it, and investors want this. It gives them diversification. And I would so I also want to create I want to educate people on the difference. So for instance, a few funds, like there's a Blue Owl private debt fund that ran into restrictions. So they're restricting the amount of money that people can take out each quarter now.
Hmm.
It's kind of been bad how it's been reported. They actually accelerated how much people could get out, but then they gave 30% right away. But then moving forward, they're going to restrict it because as they wind down that fund. So those are like private funds. They're not traded on the stock exchange. They're not liquid. They're not nearly as liquid. Though that area I've never really wanted to invest in. I don't think it's highly attractive, but most of Blue Owl's capital is publicly traded vehicles. Like they have a lot of like so the BDCs I've mentioned, for instance, are publicly traded BDCs where you have the opportunity to buy them at discounts to net asset value. They're permanent capital vehicles, so there's never any withdrawals. There's no
Okay.
forced selling of these types of vehicles. You just get your dividend. You can sell your stock if you want liquidity, but that's very different than these private funds. So I just wanted to notate that difference in them.
Interesting. Okay.
Yeah.
In fact, speaking of a few companies, you've mentioned Blue Owl, and I think weren't they the one, was it last week or this week? They had a $25 million write-off um, of a
Yeah.
fund. And then all of a sudden, every headline talks about, cracks in the system. And I
Right.
thought, well,
Exactly.
you know, it's was it $6 billion fund? Is that
Right.
right?
Right. Oh yeah, yeah,
So,
yeah. Some of these are like $14 billion of assets. It's
right.
crazy. Like so they're very small numbers. And so you have the business development companies which are taking credit risk. So those ticker symbols are like OBDC, OTF, MSDL, BXSL. Those are all business development companies that are taking credit risk. But what's funny is you'll get a headline like that where this they might take a loss on a certain a loan, but then they're selling off OWL, which is the actual asset management company that doesn't take any credit risk.
Hmm.
OWL just manages the funds and they're growing like crazy. So, as you know, like the management fees keep growing the more assets you get. Very lucrative business. I think the last I looked, the dividend yield was something like 9.8%, and they just raised it. Very rare, very rare to get an asset manager, a growing asset management company, a very high quality business at that type of dividend yield, earnings yield with phenomenal growth prospects. It's a pretty young company. They've only been around for a few years. I mean, it's not an
Right.
old. And I even remember when Blackstone went public in their IPO. It did okay for a little bit, and then I think it was like right before the financial crisis, the stock tanked, and everyone was like, "Oh, what a horrible investment that was." And since then, it's done nothing but go up. It's probably had like a 500% rally,
5x.
or
Yeah.
at least. So I think that there's really, like, not to be hyperbolic, but I think that OWL, for instance, is a stock that could go up 200, 300% over the next decade. Maybe sooner, maybe five
Okay.
years. The stock was trading at like 23, 25 less than a year ago. And so it's people have short-term memories. Right now, they're just all reacting to headlines. I've been buying more. I'm quite confident in it, but everyone do your own diligence, of course.
Right. So, OWL, OWL, is that the
Yeah,
symbol,
that's
right?
the ticker
Yeah.
symbol for
So
that. And yeah, we
you're
own all those stocks. We own all the stocks that we've mentioned, uh, myself and our investors. Yep.
OBDC, right? That's another one.
OBDC, OTF is the technology fund. What's funny is everyone's all worried about software. Software loans have been the best performers. And here's another important thing. So the underlying companies that these loans are on, they're actually doing really well. They're growing their EBITDA, they're growing their revenues. Their interest coverage ratios are actually improving. Yes, there's a few defaults here or there, but it's very low numbers, and there's always defaults. It's not rare. That's what the business is.
Right.
But you get one or two and they're in the headlines. And a lot of the defaults that people talked about, like I think it was called like Tricolor Holdings or something, or and the First Brands Auto. I'm kind of blanking on the names. There were two big ones last year. They were bank loans. Like they weren't even private capital. They weren't
Okay.
even private debt. So it's just interesting, but it caused so much fear. So
Right. Right.
so yeah.
So are these, for example, there's another ticker, OKE.
Yeah.
And is that something that, in I guess whether it's that one or some of these other symbols, are you typically adding options sort of as an additional enhancement on these tickers, option strategies, or you do so just sort of in a targeted manner? Some tickers, some
Yeah.
stocks you look at in
Yeah.
that
So
regard, and others you don't.
correct. So like the BDCs, the options aren't usually great. Sometimes they're decent. Like sometimes you can sell calls at like right around net asset value, and then you're getting the high dividend, and you're also getting the additional premium from the
Right.
options. And we could go into that more down the line. You mentioned OKE, that's ONIOC. That's one that we talked about in our last presentation. That's a pipeline company. It's an LLC doing really well. I love the pipeline space, and I think that this war, the unfortunate war, is
Yeah.
is going to be really good for American energy infrastructure. And so that stock's done really well. And so for a stock like that, we'll sell puts, we'll do covered calls. So then it's great. You get like maybe a 5-6% dividend, very different companies than BDCs, but then you might get another 6-7% on the covered call. So if the stock's flat, you're getting double digit returns. And you know, I think you and I agree. The next 10 years are not going to be like the last 10 years in terms of market returns. If you can average double digits over the next 10 years, I think that's going to be a heroic accomplishment. I think the
Right.
market's going to do far less. So I'm excited about those strategies.
Yeah, absolutely. I mean, you're going to have to, you know, kind of cut across the grain a bit and do things that have traditionally, been working that'll no longer work. You're going to have to step outside, and, managers and so forth, people doing their own investing, you're going to have to really step outside that bubble of familiarity and, really sharpen your pencils, I think, in the next 10 years. It's not going to be, I think people have a recency bias,
Yep,
and they tend to feel like sometimes they look in the mirror and all their stocks have gone up in the last few years, and they tend to think they're a good stock picker. But sometimes it's just the environment. You're in a bull market, and
exactly.
glad you're doing well. Everyone's doing well, and that's all.
Yeah,
That's all fine. But
yeah,
if you've been around long enough, that we all understand that doesn't always last, or it doesn't last.
agreed.
Um, so dynamic shift, the money flow shift, and even the options market itself is now actually becoming a large influence on equity prices themselves.
I never
Uh,
thought you'd see stuff like what we see. I mean, when we were doing options 20 years ago, we would go what, like 45 days out, 60 days out
right,
with and now people are doing daily options
one
that
hour.
expire. Yeah, it's crazy. I never
Yeah,
thought you'd see anything like, I mean, it's more of a casino than a casino.
Yeah,
Uh,
I've seen
yeah,
strategies where, people are suggesting, okay, zero DTE is all great, but we're going to show you how to just get in there in the last hour.
yeah, yeah. I mean, it's kind of like yeah, those newsletters they used to have and stuff like that, and they still have them. So I think people should be careful. And one of the things is this: it's not just about like trying to like outperform. It's of course outperforming over the long term is a goal, but it's also what we try to work with clients about is meeting your retirement goals. So we can all
Good
play
point.
Monday morning quarterback and look at it. Well, if we would have known we'd be 17-year bull market in 2009, all of us would have just been long stocks the whole time, 100% stocks, even if we're 70 years old. That would have been great because we already know what the past was,
Right.
right?
Hindsight's
But
2020.
right.
That's obvious. Yep.
But if you're 70 years old and you're retired, can you handle a 40% correction? And what's disheartening, frankly, is that we review portfolios all the time and we see so many clients that are retired and they'll have 100% exposure to equity. And I'm
Hmm.
like, Mr. Mrs. Client, how would you deal with a 30 or 40% correction in your account? And it's like, oh no, it'd be totally devastating. We'd have to totally change our lifestyle. Okay, you cannot own this. And
You
it's like,
cannot
well, it's
afford
worked
to
out
be in
well.
this.
Yeah. Well, it's worked out well. But yes, it's worked out well until it doesn't. And it's just like in 2007 when people were over leveraging on real estate, 2000 when there's tech stocks. So we're in another one of those periods where people are forgetting about risk. And so our job is to educate people to not make those mistakes. So make the adjustments prior to that major sell off, which in my opinion, probably going to happen sooner than later.
Well, I tell you, I think that's absolutely key what you just said. As a money management firm, your role isn't always necessarily not, and it's not always going to happen where you're going to outperform a particular index on any given month or week or year by just a metric of returns, but you do so much more. And that is if you can help people avoid a 30 or 40% drawdown. Because if you have here's a real simple thing, and it's simple math, but it's amazing how many people miss this fact. If you had let's just, God forbid, you had a 50% drawdown in your portfolio, uh, a lot of times people don't really quite think about it closely enough, and they just think, oh well, um, it'll recover.
Right.
It's like, okay, well, to recover to back to where you were, it's not a matter of just generating another 50% return.
Yeah.
And the math doesn't work like that.
No,
You
no,
have
it
to
doesn't.
generate 100% return.
Exactly. You're
So,
correct.
and those are hard to come by.
They
And
are.
also, you mentioned too, depending on a person's timeline, whether it's their age or whether it's their goals financially, uh, that are shorter term or not so far out on the horizon. If you have a drawdown like that, you may not have the time you need to recover, even if the market turns around and starts doing well again. So,
Right.
it's a matter of risk adjusted return and also meeting your goals as well. So,
You're speaking my language. That's exactly what I emphasize. Risk adjusted returns,
right,
making business like decisions, don't use crazy leverage, all of that stuff. So I couldn't agree with you more there.
right, right. Well, very good. So, any other tickers that you want to chat about, or you think you've
Oh,
kind
I
of
think
covered
we
enough
covered
ground?
it. We'll
Okay.
cover more next week and
Yep.
elaborate more. But no, thanks so much for taking the time, and it was fun. And we'll make this a weekly ritual. Be good.
Yeah, we can do this absolutely. And how can people get in touch with you, and what do they need to do to get involved? And I know you did a book
Sure.
recently, and they can
Yeah.
probably access that book as well. So if you want to tell
Yes.
people how to do that.
Yes. So our website's www.ttvalueinvesting.com. And yes, the book links there. And also our blog, which is a very good resource. I suggest people sign up. And they can email me or call us directly. All the phone numbers are on the website. And so, yeah, thanks. We're happy to help anybody, and we take your finances very seriously. We want your money working as hard for you as you do for it.
Very good. All right, Tim, that was great, informative, and hopefully, in a little bit entertaining as well. So we'll see you next week, everyone. Thanks for joining us. And thanks again, Tim.
All
And
right,
have a
perfect.
great weekend.
Thanks, Eric. Talk
Okay,
to you soon.
bye-bye.
Bye bye.